Moving forward, we have another people on the stage who are again going to be talking about something which is again my one of the best topics, LP Investment Officer Perspectives, Best Practices in Sourcing Opportunities and Due Diligence in Today's Market. May I please take the pleasure to call on the stage Norbert Fernandes, Vice President TR Capital. Everybody, please welcome them with बहुत जोर शोर से तालियां. Come on. Great. And then we have Siddharth Jhunjhunwala, Managing Director and Head Alternative Investments from Waterfield Advisors. Everyone! All right, to the speakers and to the gentlemen, thank you so much, and stage over to you.
Thank you very much, guys, for being here and hearing us today evening, especially before tea session. We would try to keep it short, and also we'll try that you don't feel sleepy. And I thank my co-panelist here, Siddharth Jhunjhunwala. Siddharth is the Managing Director and Head of Alternative Investments at Waterfield Advisors, and Norbert Fernandes is the Vice President with TR Capital. My name is Ajay Vaswani. I take care of the alternate investment fund business at ITI, the Investment Trust of India. See, being into this alternate investment space, in this ecosystem for quite some time now, what I realize is that there is huge scope of growth for this opportunity in India. And what do we need as the industry participants is, first, the awareness, second is the knowledge, and third is the visibility. And I see that Equalify is doing all these three things through the platform. And I would like to congratulate Aditya and Equalify team for taking these initiatives and bringing such kind of opportunity on the fore, because if I was just thinking about this, if I wouldn't have been there into this session, I would not actually know what kind of diverse funds are available there into the alternate investment space. And my knowledge would have been so little. Though we were also fortunate to be the title sponsor in the last 9th Alternate Investment Summit. ITI Investment Trust of India was the title sponsor. From there we got to realize that what kind of opportunity and size is there in building this alternate investment fund business. So though there are multiple topics on which since morning we are hearing our panelists to talk upon, this particular topic is about the best practices in sourcing opportunities and the due diligence with the LP perspective. So by now you would have understood that I don't have any knowledge to share. I am here to ask questions and I am the moderator. But the panel which you see here, these two people, when I was interacting with them, I realized though they are only two, though they are only two, but they are very diverse knowledge sets. And that was very exciting for me to come up on the stage and share their knowledge with you. So on one side, where Siddharth is actually a kind of a fund of funds who does due diligence on various venture capital funds, VC funds, and invest in them. On the other side, Norbert is a guy who actually provides exit opportunities to the venture capital funds and buy their stakes in the company. So a secondary market. So one is the guy who looks into and does due diligence for the venture capital funds, and the second guy, Norbert, is a person who will give a secondary market opportunity to the VC funds. So Norbert, my first question will go to you. See now what we have seen in our markets, especially into the venture capital space for private equity space for last 12 months, 18 months period, we have seen companies raising money at XYZ higher valuations, and then a reality check happens when companies get listed or when they are questioned on the earnings. And then we also saw in the corporate world with the recent event that there's nothing too big to fail. We have seen it recently in the corporate world. Now, considering that, what I would like you to talk about is, first of all, it will be great if you could tell the audience what do you do.
Sure.
and how it has evolved in last 12 to 24 months.
Sure. So Ajay, first of all, you're absolutely right. The term alternative investments is a bit of a catch-all phrase. So there are just so many types of strategies and types of funds and flavors of, teams that are, operating under the alternative investments. Where I think you throw a stone and throw a second stone, it hits two people. Both those guys will be doing very different things, but they will be alternate investment, just like we both are, right? So what I do, so I run the India team of a secondary fund which is Hong Kong headquartered called TR Capital. And like you said, right, we are one of the few secondary specialists within the space who specialize in buying stakes from other investors rather than putting primary money into a company's cap table. So we do that either in a single asset, we find someone who's willing to sell their stake and we buy it from them, or we talk to fund managers, both PE, VC fund managers, and for multiple reasons, including the fact that these funds have a time period and there's an end of life during which they do need to exit. So at that time, if out of their 10 investments, 3 are still left, we could maybe take over that portfolio. And there are multiple models to do that. We could just buy those stakes outright. We could form some sort of continuation vehicle. There are many, many modalities to it. But yeah, that's kind of what we do. And we've been in India for 10 plus years, and we've been at it. It's not new for us. We've been around from the time that we were investors in Flipkart and fully exited to Walmart, to now we are investors in Lenskart, Big Basket. So a lot of consumer financial services focus. So how it has evolved, maybe I can speak a little bit about. It's been the last 2 to 3 years have been pretty much a roller coaster ride, I would say, in terms of how the market has evolved. I think during the pandemic, you would have seen a lot of digital native brands and platforms raising gobs of money at ludicrous valuations, if I may say so. And the fact is that COVID accelerated a lot of the digital growth that was probably expected to happen over 3 to 5 years, but kind of got compressed into this 1 to 2 year period. So on the back of that, a lot of money was raised, and there was a lot of availability of money also. So now what we're seeing is there's some sort of moderation in expectations because some of that growth has fallen off. And some sectors very naturally have cooled off, like edtech, because there was an explosion of edtech during that time where there were actual online solutions required, but now it's not required anymore. So there's a big part of the market that got overexcited, overhyped. A lot of money was raised. So how did that impact us? We didn't do too many transactions during that period because nobody, as you can imagine, right? When you're an investor in a company and the valuation is getting marked up, 50, 100% every 6 to 12 months, no one wants to sell. They want to take that ride along for longer. But so we've been very, very focused on fundamentals. So we did not get into the game of can we match that price, which we are not really confident on. But since then it has changed. Obviously, last 6, 12 months, things have become a little more moderate. A few companies have listed and the market has spoken on them. So I think it's returning to a part of the cycle where it's easier for us to do deals, and we have gone aggressive. We've closed a large transaction last month. We're in the middle of another one. So I try to behave counter-cyclical in a sense, but yeah, I mean, it's hard because the market is, all speaking in one voice and you're saying that this doesn't sound right, so you try to do something else. So that's how it's been. It's been a roller coaster last 12, 24 months.
But generally, Norbert, markets generally associate secondary investments with discounts.
Yep.
How have you seen this trend of discount to NAV changed or evolved in the period?
It's an interesting question because yes, there is this perception that if a secondary transaction is happening, that automatically means 15, 20, 25% discount to your NAV or where the last round happened at. That of course is an oversimplification. And I give you a very simple example. There are companies that are profitable have not raised money for the last 3 years. How can you, do a secondary at a discount to that last round raise? There's just one example of why that logic doesn't make sense. The way we think about it is a discount to anything is just a way of representing a price. We do our own work and come up with what is a fair price for an asset and try to make a deal work at that price. But in terms of trends, right, I think that's another very interesting question because it's been all over the map last 2 years. What generally, I think, very thumb rule, what used to happen is if there's a round that has been raised recently, a secondary trade would happen at 5 to 15, 20% discount to that. But what has happened now is the market seems to be bifurcating very clearly between companies with strong unit economics and the ones which are burning cash and don't have a line of sight to profitability. So the discounts on this type of business, I'm seeing as high as 50, 60, 70%. And there are people in the cap table who are saying just, I think before something bad happens, let's just get out. And they're lining up to the door to exit. We have those conversations regularly as well. But the companies that are fundamentally sound, even if they are cash burned today, but at a unit economics level, it's pretty healthy. And they're burning cash for a real good reason, which is to grow. Those companies are still, very healthy off, and there's no major price correction as such that is happening there. And that's the way it should be, right? I think when there's a lot of capital, everybody gets valued richly. When capital sort of pulls back, it starts separating the good businesses from the bad, and that's a natural part of the cycle. So that's what we're seeing.
That's very insightful. It throws light to a very important part where people talk about secondary at discounts. So, Siddharth, it'll be great if you could now let us know what do you do and how it has evolved in last 12 to 18 months.
Yeah, great being here to start off with. I've been pretending to evaluate fund managers for the last 9-10 years. And suddenly Waterfield Advisors decided that I could be good at it. So they hired me. I was largely based out of Hong Kong working at a large fund of funds. And the mandate that was given on March 2nd to me was to actually set up the fund of fund platform. And within 20 days, there was a lockdown, March 2nd, 2020. So, of course, not a great start. So what we did here was that we sort of set up our first fund of funds. Of course, there are the likes of SIDBs, etc. But I think in a way, we are probably the first fully privately owned VC and PE focused fund of funds. So what we did is that could we eventually set up a very institutionalized way to give all the private market investors, both domestic and international investors, access to, say, probably the top performing fund managers, a well curated, well diligenced portfolio of funds. And at the same time, can we also selectively invest in co-investment opportunities? So this is a very basic fund of fund business model that we, of course, tried to create. The idea was always that can we go ahead and institutionalize this aspect of giving exposure. There are a lot of family offices, HNIs, who want to, of course, get access to the best of funds, and sometimes because of the lack of bandwidth, lack of the ticket size they write, or probably even the best of funds don't actually want to deal with the family offices and the HNI investor set. So we thought that, okay, if we aggregate this and if we sort of overarch our expertise on this platform, can we sort of create a good portfolio of funds and select co-investment opportunities? So that was the, of course, idea. Over the last 2 years, I mean, of course, everybody's seen what happened in 2021. It was euphoric for the private markets. Good reasons, bad reasons, that's, of course, whoever's made money and who's not, that's for them to decide. But what it did was that it made a certain sort of urgency and opened up a lot of capital and particularly domestic participation in the private markets. So thankfully, because of that, we were able to raise our fund one, closed it, and again, we were very fortunate that a bunch of very solid fund managers also were out there raising capital. So everything sort of aligned. So this is what we do, pretend till the time we get good at it. So did that. Now with respect to the evolution of this industry, I think this was a much needed industry to begin with, solid LP, whether you call it fund of fund platforms or the DFIs actually sort of coming in, participating and supporting the growing private market ecosystem. What it led to it is that, again, just going back, and probably I must have used this word 5 times, but I'll use it the 6th time and probably promise not to use it. But I think it just gave us the opportunity again to streamline portfolio construction, exposure. Can we give them preferential rights? Can we be more active in terms of managing those investments? So that was the evolution that started. I think, of course, there are large institutions like NIFs of the world and of course SIDBIs of the world who have been sort of participating and sort of helping the ecosystem. But I think it gave us, Waterfield Advisors, it gave other competitors who are coming into the market an opportunity that something like this is needed. Now, why did that happen is that, look, of course, if somebody would have told me, can you come back in 2017, 18 and set up a fund of funds, I think an India-focused fund of funds in India, I think the answer would have been a very clear no, because India clearly lacked the depth in this space. Very quick, it looks like there's not a lot of depth right now, but I think I'm still always a little more cautious. Probably Waterfield might not be, but I, as an investor, are a little more cautious because I've seen the tough times and I've gotten a bit more scarred. So no matter what happens, I think eventually the idea is that the evolution towards doing very thorough diligence, how do you think about sourcing opportunities? How do you think about evaluating fund managers? That's becoming a very interesting aspect. And I think second is that, there were a lot of fund managers. In fact, every fund manager wanted to raise international capital. And they ran to the US of the world largely to sort of, raise capital. I don't think you need to do that anymore. And I've heard so many times, and even when people came to us for raising capital when I was in Hong Kong, the first, if it was an hour's meeting, 55 minutes went in talking about India and 5 minutes about the fund, right? And it was largely a waste of time for several fund managers. And I think it also impacts their returns. It also impacts the wealth they generate for themselves. I think that is a good change, I feel, and it's a much needed change in the evolution of this space, that I don't think Indian fund managers should really go out for international capital. In fact, international capital should probably find ways of reaching out to the best of guys and find ways to invest in India, rather than we really going out and raising that capital. Having said that, we are raising our fund too. We are raising international capital. But in a way, can we channelize that more thoughtfully in India? Because I feel that I think even the international guys have not been in a way, had the right approach for India. India was always like a part of that emerging market. Everybody just focused on China. But I think now is probably more of India's time, because there's a lot of portfolio reallocation that's happening. And I really hope that fund managers should not really travel, waste their times there. I think we are there for them to do that. And so good evolution, solid evolution, much needed evolution. So
I completely agree to you that markets have realized the value of private equity and unlisted space investing. My 80% of the time goes in meeting ultra HNI investors, corporate treasuries, and family offices. One thing which they have clearly realized is that most of the wealth creation happens in the value creation journey of the company between startup to listing. And everyone wants share of that pie. And investors who have got early wins also in this space. And there are angel investors who have gone ahead, invested into startups, and those startups have become big. Probably they would have invested into 10 different startups. 2 did well, 8 went bad, but those 2 companies have given them great multiples. Looking at this, what I see that multiple angel investors have gone ahead and become fund managers and want to raise capital. In your opinion, is it good for the overall market or otherwise?
I think that's a great question. The way I look at it, look, investing is one part of the fund management business. You know, I think you can be a good investor, but eventually you have to think of yourself as an entrepreneur at the end of the day. I think it's about choosing your right co-founders, it's choosing the right team, incentivizing the right team, and being excellent at your job. That is, one is of course right from sourcing to harvesting to sort of seeking exits and timely exits, right? India, of course, with respect to DPIs have always underperformed when you sort of compare it to other emerging markets. But so I think that sort of a line needs to be understood by the angel investors themselves. That, you know, am I a good fund manager or am I a good investor alone? You can, of course, you know, I don't want to use the word luck. Probably they're extremely smart, got into the right time, and I think it takes a lot of guts to sort of even enter at an early stage and start taking out those bets. But I think it's if you are wanting to become a fund, if you are wanting to enter into that fund management industry, I think again going back to the thought that you have to think of it as a very institutionalized setup where decision making to incentivization, to retaining, to what kind of a brand you want to build for yourself. Are you able to position yourself as a fund where probably the best of founders will come knocking on your door, right? So I think there are several steps that one needs to take from transforming from an angel investor to a fund manager. Of course, there's no school for that. So what people do is that they feel like they can raise funds. Many of them do. I personally feel that probably not always the best for the entire ecosystem. You know, the more the capital and the more the way fund managers are selected is like, okay, I know this guy, he's a good investor, chalo isko paisa de dete hain. I think if you start up only going with that sort of an approach, more number of times you might just end up burning your hands. And what happens is that then you don't blame the fund manager, you actually blame the entire industry. You say that, arey, VC mein to it's not going to work. Yeah. This thing, because the fund manager will also come back and tell you, okay, fine, because the market was XYZ, we couldn't do it. But the idea is that if we are paying you 220, you need to steer through this, right? And not, India is a challenging market. So let's not even forget that. It's a challenging market. So then you need to sort of, you know, as LPs, we need to set our bar of diligence a lot higher and very rigorous to sort of identify and this thing. But just to, you know, in a short way to answer your question, I think it's a certain evolution. This happens. Takes time for investors to become fund managers. I think the journey is important. And some of them deserve the capital, some of them get lucky, but I think if you're just true to it, probably it might just work, and for us, it's very good.
So how do you go about sourcing the opportunities?
So I think with respect to sourcing the opportunities, what we do is that it, I think, stems from the fact, how do you want to position yourself in the market? Okay, so I think I can give you an example that, say, the fund of fund that I worked with and the fund of fund right now that we've set, the idea was always that we want to be high conviction check writers and be large LPs. In a way, can we just come right at the time when you're thinking about anchors? You know, this is of course the journey that we are on. We are not opportunistic. We are not small check writers. So, and if that sort of goes out in the ecosystem that, Waterfield Advisors, the fund of fund generally will back you big. So you will sort of get those kind of opportunities. The best of, say, probably the spin outs, right? Uh, we would love to sort of, participate and grow a spin out opportunity. But if I am like, say, an opportunistic LP where I'm writing $3-4 million, those guys are not going to come to me initially. And for me, because I'm looking for certain rights, I want to, of course, be before a first close check writer. And the third aspect is that the signaling. Right. What can a Waterfield's check signal to the market? Of course, we are small, but the way we are approaching it, I think, in the journey to $1 billion fund is that that if we are writing a check, we should have followers. And in a way, a lot of LPs actually work that way, that they are more fence sitters. And when they see some large investors coming in, then they sort of write the check. So we don't want to be fence sitters. We want to thumb the table and back the right fund managers. That's the approach.
Perfect. Norbert, people here know something about private equity investments, venture capital funds. In fact, many would know a lot about it, and they perceive that they know a lot about it. It's true or not, that differs. But as far as the secondary market for the private equity unlisted space is concerned, that not many of us know.
Yeah.
So here today we have an opportunity to talk to somebody who is giving opportunity to these venture funds to exit. So I would like to understand from you how this market has evolved in COVID and post-COVID times.
Sure. So you're right. The secondary space in Asia is fairly nascent, I would say. But that's not to say that in developed markets like US and Europe, it's a very, very well established strategy. There are multi-billion dollar funds which just do secondaries. And so there's a flywheel which enables flow of capital, which is very smooth in developed markets. So you have a VC fund which funds a company in the early stages, then probably it moves into the PE stage, then maybe it gets listed. If it doesn't get listed, maybe there's an M&A exit. There are very, very large acquirers, serial acquirers in fact in the US, especially for tech. If that also doesn't happen, then there are secondary funds which enable liquidity. So it's very important in a private equity or private market for the channels for capital to keep flowing, be smooth and well established. Now, so we are obviously behind the curve in terms of evolution. So till now, a lot of the focus in India has been actually raising capital, which meets the requirements of the companies that we desire to build out as a country, as a group of entrepreneurs, etc. So a lot of it has been, how do we attract FDI into India through various formats, right? That makes sense. But over a period of time, that problem statement starts shifting to, okay, we've raised a fund for a life of 8 years plus 1+1. Now, 10 years into this cycle, we need to find an exit, right? We've extended the fund. IPOs in India take a bit longer than developed markets. On top of that, the capital markets in India are very, very bottom line focused, traditionally at least, and it's changing. But if you go to market with a tech company that's still growing very fast and burning cash, well, only there are a few data points of listings of that sort, but it's not easy to list a company like that. So what is left? The M&A market also is not hyper, I would say, active. You do have Indian conglomerates that acquire, but I don't think they're the best paymasters when it comes to acquisitions. So there is a gap between what has been deployed and what needs to be exited and what exits are actually happening. So that's where the need for a secondary market to kind of complete the circle comes in. And it's a more recent problem, therefore, It's become a more recent focus for secondary funds to even look at India. Um, and I would say China is a little bit ahead. It's a little more established market, but overall, still in Asia, there aren't too many Asia dedicated secondary players, and honestly, there's just a handful, and even fewer have teams on the ground in India. I think there's just two. So that's in a nutshell, how the whole market operates. And so we think that the next 5-10 years is going to be a really good opportunity for the secondary strategy in India. Obviously, listings and M&A will also be very, very viable and increasingly viable exit mechanisms. But there is a place for good secondary funds to come in here and complete the loop on generating liquidity for LPs in India.
Which sectors do you think are you seeing most opportunities in the secondary market space?
So I think that answer will be a little biased because it's biased by the fact that we look at only a few sectors. So across the board, we are seeing a lot of secondary opportunities in consumer tech, financial services, healthcare, especially a lot of companies that have by nature have raised a lot of capital, and therefore they need to exit a lot of capital in the cap table. Asset light companies or companies that have not raised a lot of funding, they won't feel the the need to find a secondary solution for their investors. So it's a bit of you could say the faster growing companies that have raised a lot of capital. That's probably the meat of the market right now, where the solution is most it will be required and it will be a burning issue in a few years. Yeah, so that's where we are seeing the opportunity.
That's indeed insightful. Yeah, Siddharth, as a fund of funds, you have a fiduciary responsibility towards the investor.
I think.
Yeah. So, very, very important question is that what do you think are the best practices in terms of the due diligence for the fund?
I don't know about best practices, but what I do is I can tell you that. So I think it all starts and stems from the fact that can you be with this team for the next 10 years? It's more like a marriage, but it comes with a renewal. So I think it's all depends on how much time you spend with the fund manager to sort of. I feel it's more of an EQ than an IQ business. So I think again I've sort of spoken and touched upon it a bit before. So I think one is for me. I don't think I look now. India is in a space where I don't think one GP sort of works. I think you need a lot more horsepower. I think a very qualitative team where probably 2 or 3 people come together to set up a fund, and with all of them having an equal say in the decision making process. I think with respect to how they're able to share the carry with the right amount of talent in the team so that they end up retaining them. Say for example, a VC fund, it depends on how they treat the founders, not just the ones that they've invested in, but just generally. Giving respect to the founders is extremely important so that your deal flow sort of continues to grow. Very important, the kind of brand, say probably a venture capital fund today is trying to build. Then of course this is the team, moving on to the portfolio, touching on what Norbert said is that of course in 2021 everybody's fund performances were upwards of 50%. Nothing below that. Now, how do you underwrite that? And can you actually really dissect the portfolio and see whether this portfolio is at 50%, 15%, 20%? What will it be by the end of the fund life? And I think third very important leg for diligence is reference checks. Very important to corroborate the story with their peer set, with their founders, with the other LPs, returning LPs, new LPs, etc. So I think broadly these are the 3 aspects that we sort of tend to cover. But I mean, probably I'm not doing a very good job answering this question because I really don't have like a checklist that I follow. But I think it's more so it's a very psychological business in some way or the other, because you're trying to sort of figure out which kind of a fund manager is actually an AUM chaser and which one is actually there to generate wealth. I think that sort of a bifurcation is extremely important.
I can point to one thing that we are seeing change in due diligence. So 2021, because it was so euphoric, right? I think a lot of due diligence, the standards fell. And also because there were physical lockdowns, right? Actually doing a physical due diligence was that much harder. So companies raised money on the back of probably incomplete due diligences, and you're seeing some of those issues play out now. So we are seeing a lot of more emphasis returning to just hardcore accounting due diligence, forensic due diligence, background checks, a little more hardcore than what it used to be. And I think, that's good. I think discipline needs to come back into the market, and it's coming back in the right way.
No, you're perfectly correct. I can't agree more in that. As I already told you guys, these are only two people, but it is very diverse panel, and I'm sure I can spend another 1 hour with them discussing at length. But with the paucity of time, do we have time to take Q&As or?
One or two maybe is good for them. Anyone from the audience would like to go for Q&A? Anyone? We do have one. So could you please raise your hands up? Thank you. Well, gentlemen, it was a wonderful session of India and going abroad as well. I could relate that, we should have some subjects in the school as well for this, so that our students should read it about in the school. Yes, gentlemen, your question, please.
Yeah, hi. So I work for a VC fund. So I sit right in between the two of you. One is my investor and the other is where I exit. So I'll just have a quick question for both of you. Siddharth, for you, how challenging is it to raise funds from institutional LPs? Because, funds like us reach out to them directly anyways, right? So they have access to us. And the question for you, Norbert, really is that what is the significance of the fund manager's performance on his investments for you to take a decision on whether to invest in those exits or not?
Maybe I can answer first. So the fund manager's track record does play a role in at least us assessing whether the team is strong and capable and finding the right opportunities to invest in. Therefore, their companies are strong. And each fund kind of over a period of time builds a pattern of what they look for in companies. Some teams only look at very asset-light businesses. Some look at very fast-growing businesses and growth at all costs. So each one has a flavor of its own. So we try to kind of do work with funds that we identify with their strategy as much as possible. But having said that, very selfishly, we are at conflict of interest, right? If I buy at a really good price for me, his returns suffer. So I can't be too fixated on him making a good return, because then I will suffer. So you see where I'm coming from, right? But as a track record, of course, we try to work with fund managers whose strategy we do identify with, and we also think about companies the same way as they do.
So look, I think raising capital is always challenging, right, to start off with. I don't think it's an easy approach, but I've seen fund managers raise sizable amount of capital in 6 months, and I've also seen fund managers really struggle to raise capital, right? I think again, sometimes it's a function of where the economy is, where the market is. Like in 2021, probably everybody could raise capital, even with a half-decent performance, because of the FOMO that was there in the market. But if you want to look at it consistently, for a first-time fund manager, like 2023 will be a tough time to raise capital, right? But and NCI, I can tell you that internationally, of course, raising capital in India is always very tough because of the whole India preconceived notions that they have. I think from an institutional LP, if you are able to sort of demonstrate good DPIs, thoughtfully constructed portfolio, solid teams, right? And if you're able to position and build a very good brand for yourself, particularly from a VC fund, and instead of really being like followers, are you able to sort of take that bet of, okay, how do we differentiate ourselves, say, from other VC funds? I think that kind of story definitely is digestible, and if there's merit, I think definitely, I mean, you are well positioned to raise capital.
By the way, there's a correlation between fund performance and the year in which you raised funds. Was it hard to raise funds in that year or not? The harder it was to raise funds, chances
The
are you've
better the
done better
performance.
as that vintage of funds.
Yeah.
Just because raising funds was hard, so therefore valuation environment was also lower. So you entered companies at at a good price.
No, wonderful wisdom you shared. This will be part of the due diligence process. Perfect. With the paucity of time, I think any other questions can be sent via email to
Yes, you can. We
Qualify
can have
and
it
they can
offline
connect
as
with
well,
us.
or you can send the emails as well, gentlemen. All right,
you very
thank you
much.
so much for this wonderful session over here. May I please call on stage Alok Sasmal from LSEG for felicitation round, please. Everyone! And a small token of appreciation for Qualify, and a small picture, please, to make it a picture and a stage perfect. Thank you for a beautiful moments.